Today, we are going to tackle two terms in finance that sound kind of similar, but trust me, they live in completely different worlds: book value and face value. You see, one is like an accountant's ongoing story, always getting updated. The other? It's a promise, set in stone from day one. And getting the difference is absolutely key to understanding what a company or a bond is truly worth. So here's our game plan. We'll start with the big picture of value, then we'll dive deep into book value, and then face value. After that, we'll see how they both clash with market value, talk about where things get a little messy, and wrap it all up with your final takeaway.
All right, let's jump right in. Section 1, a tale of two values.
I mean, it seems like a simple question, right? But the answer? It's surprisingly complex. You see, in the world of finance, value isn't just one single number. It's a concept, and we measure it in different ways for very different reasons. And this is exactly where book value and face value enter the picture. The best way to think about it is like this. Book value is the story the accountant tells you. It's like a running scorecard of a company's net worth based on its books. Face value, on the other hand, is a promise that's basically carved in stone. It's a fixed number that is not going to change. So let's dig into the accountant story first.
So, Section 2 is all about book value, or, what a company is supposedly worth on paper. Now, the key word to latch onto here is theoretical. Book value is a pure accounting figure. It is not what the company's buildings or equipment would sell for on the open market today. Nope. It's based on their historical cost. It's really just a snapshot of solvency pulled right off the balance sheet.
And the math behind it? It's actually beautifully simple. You just take everything the company owns, that's its total assets, and you subtract everything it owes, its total liabilities. The number you're left with, that's the book value. You might also hear people call it shareholders' equity. It's the same thing.
So, for example, let's say a company has $500 million in assets. We're talking cash, factories, inventory, the whole shebang. And let's say it has $200 million in liabilities, like debt. Well, its book value is a straight shot, $300 million. That is the company's net worth, at least on paper.
Okay, now let's pivot to our other value. Section 3, face value. If book value is the accountant's story, then face value is the contract's solemn promise. This value gets set one time right at the very beginning, and it never, ever changes. Now, technically, stocks do have a face value, but honestly, it's usually some tiny number like a penny, and it's pretty much irrelevant for investors. Where this number is king, though, is in the world of bonds. For a bond, the face value, sometimes called par value, is the principal amount you are guaranteed to get back when it matures, assuming the issuer doesn't default, of course. Face value does two incredibly important jobs for a bond. First, it's the finish line. It's that $1,000 or whatever it is that you get back at the very end. And second, it's the anchor for your interest payments. A bond's coupon payments are always calculated as a percentage of this fixed face value, no matter what the bond's price is doing on the market day to day. This actually leads to a really cool concept in the bond world called pull to par. Let's just watch it happen. Imagine a standard bond with a $1,000 face value. Let's say it has 10 years left until it matures, and in the meantime, market interest rates have gone up. That makes its fixed coupon a little less attractive, right? So its market price might dip to, let's say $990. Okay, now let's hit the fast forward button 5 years. We are much, much closer to that maturity date, that day when the issuer absolutely has to pay back the full $1,000. So knowing that guaranteed payday is coming, the market has naturally started pushing the bond's price up, getting it closer to that final number. Now it's trading at $995. And then, on the exact day that the bond matures, what's its price? You guessed it, it's exactly $1,000. It has been perfectly pulled to par. That contractual promise of the face value ultimately wins out over all the daily market noise. So, this brings us to the main event, the big showdown. How do these static, well-behaved numbers, book and face value, actually interact with the wild, chaotic, and often emotional world of market value? This is where things get interesting. For stocks, we have a great tool called the price-to-book ratio. It compares the company's market price to its accounting value. So if the price-to-book is high, think of a hot tech company. It just means investors believe its future, its brand, its secret sauce is worth way more than its physical stuff. But if the ratio is less than 1, well, it could be a classic value stock, maybe an old industrial company. Or it could be a red flag that the market thinks the assets on the books aren't really worth what the accountants are saying. And for bonds, it all comes down to interest rates. It's like a seesaw.
If the interest rates out in the market fall below your bond's fixed coupon rate, hey, your bond is suddenly a hot ticket. Its market price will actually rise above its face value, and we say it's selling at a premium. But if market rates rise above your coupon, your bond is less attractive, and its price will fall below face value, selling at a discount.
But of course, it's never quite that simple, is it? Let's talk about the limitations, because these nice, tidy numbers, they can get pretty complicated in the real world.
The biggest knock against book value today is that it's just awful at measuring modern, asset-light companies. I mean, how do you put the value of Google's search algorithm or the power of Apple's brand on a balance sheet? The short answer is, you can't. So book value for companies like that can be really misleadingly low. And as for a stock's face value, well, it's become basically meaningless, just a legal relic from a bygone era.
And please, whatever you do, do not confuse book value with liquidation value. They're not the same thing. Book value is an orderly, calm accounting figure. Liquidation value is what you'd get in a chaotic, everything-must-go, fire sale bankruptcy. In that scenario, assets sell for pennies on the dollar, and those intangibles like goodwill, poof, they're worth zero. Liquidation value is almost always way lower.
Okay, that was a lot, I know. So let's bring it all home and put it all together in our final takeaway. So here's the final scorecard, your cheat sheet. Think of book value as the accountant's view. Its purpose is historical accountability, and its source is the balance sheet. It's pretty stable, and it's most useful for those old-school companies with a lot of physical assets. Now, face value, that's the lawyer's view. It's a static, contractual obligation printed right on the certificate, and it is the absolute bedrock of how the bond market works.
So I'll leave you with this final thought. The market price you see on your screen, that tells you the cost of an investment. It's what you have to pay right now. But the book and face values, they tell you the story behind that cost. One is a story of accounting, the other a story of contracts. A really smart investor knows how to read both. Thanks for tuning in.